Bond markets are at a crossroads with inflation fears on one side and recession risks on the other. What's really pushing bond yields today? You need to know now. Recent upbeat data, including a surprise growth rebound and slower declines in factory gate prices, have shaken investor confidence in a deflation-driven narrative in emerging debt markets. This shift signals that fears of prolonged deflation might be overstated, causing bond investors to rethink their positions. The evolving outlook reflects a key tug-of-war between inflation pressures and economic slowdown risks, impacting yields and investor sentiment significantly. Chinese bonds may be hitting a historic turning point. With deflationary pressures easing, yields are set to climb from record low levels. Investors are adjusting as expectations for further monetary easing by the Chinese central bank recede. This marks a shift away from the low-yield environment that dominated recent years, reflecting changing economic fundamentals in the world's largest emerging market debt space. In the United States, inflation has remained steady at 2.4% as of February. This stable inflation rate contributes to the ongoing debate about whether inflation or recession fears will dominate market expectations. The Federal Reserve's past efforts to keep inflation around 1–2% highlight the delicate balance policymakers must maintain to avoid triggering a recession while curbing inflation pressures. Historical economic protests, such as the 2009 May Day demonstrations sparked by global economic conditions, remind us how sensitive markets and societies are to economic stress. These past events underline how bond markets today are influenced not only by raw data, but also by collective memory and sentiment about inflation, recession, and policy responses. With Chinese bond yields rising and U.S. inflation steady, investors must navigate a complex landscape. The easing of deflationary pressures points toward higher yields, which could mean lower bond prices. Meanwhile, steady inflation keeps central banks cautious, balancing between tightening and supporting growth. This tug-of-war means bond markets could see volatility, requiring investors to stay informed and flexible in strategy. What this means for you is clear. Bond markets are signaling shifts that could affect your savings, investments, and borrowing costs. Staying alert to inflation trends and global economic signals can help you make smarter financial decisions. Subscribe now to stay ahead in this fast-changing economic tug-of-war.